Hello everyone, today's video is about share buybacks. What is a share buyback? Why do companies do them? Well, in recent years, share buybacks have actually overtaken dividends as the number one way to pay money back to shareholders. So why would a company choose to give money back to shareholders when it almost seems counterintuitive? They are raising equity in the first place, issuing shares. So why would they want to give that money back? Well, the first thing is if a business has grown to such an extent where it's a relatively mature business and there is nothing potentially on the horizon for future acquisitions or various strategic uses for that money, that surplus cash on the balance sheet, then that is just a cost. There is a cost to holding that money because the shareholders will demand dividends. It's the cost of equity. So these shareholders are wanting to have a dividend stream. The company is having to service those dividends, but it's got all this surplus cash on the balance sheet. So one of the reasons for doing a share buyback is to reduce the cost of equity. Why is it paying all these shareholders in the form of dividends for something that it's not using, if it's not doing anything with this surplus cash? Pay back the cash in the form of a share buyback, buy back the shares on the open market, and that will reduce the cost of the equity. So that's the first reason companies would do a share buyback. Second reason is, or to do with market sentiment and recession. So let's, in good times, during non-pandemic times or during a regular normal market sentiment, companies would look to increase their dividends year on year. That's normally the strategy that they would have because that would increase the share price. However, if there is a recession or pandemic, companies cannot do that, and they cash becomes scarce, and they cannot commit to this ever increasing dividend, and the share price suffers as a consequence. The share price goes right down. Now we've seen a lot of this at the start of the pandemic, where company share prices went south in a big way because they could not commit to the often decades-long increase in dividends. Now, some of these well-known FTSE 100 companies have been paying an increased dividend, gets higher and higher every year for decades and decades, and they just couldn't sustain that. So, but if their strategy had been a combination of lower dividends and some share buybacks in times of recession and pessimism, when you are operating a policy of share buybacks, it's a lot easier to curtail the share buyback than it is to cut back on the dividend and still try and keep the share price strong. So basically, cash is the scarce resource in this instance. If you are already doing share buybacks, you just cut them back a bit, hang on to a bit more cash. But if you've always done nothing but increase your dividend, that's going to get noticed in the market and the share price will take a pounding. Whereas if you just cut back on the share buybacks, the markets won't notice that as much, and in theory, the share price won't drop as much as it would have done by cutting the dividends. So that's another reason for share buybacks. Another reason is if the stock is perceived to be at an undervalue. So a lot of businesses genuinely feel, a lot of directors of businesses feel that their stock is genuinely at an undervalue. So what they do as a strategy with the buybacks is that they would go into the marketplace, buy back their shares from the shareholders, buy back some shares at this perceived reduced price because they think the business is undervalued, hang on to those shares in the company, and then hopefully they will be proved to be right, then that there wasn't undervalued, and the share price will increase. And once the share price increases, they will reissue those shares that they bought back for the higher amount, which will bring in more equity funding. Now the point is that they can increase the equity by doing this without diluting the company ownership. So they haven't had to increase the shareholder base to do this because they bought shares back, which reduces the shareholder base, and then reissue the stock when the share price has gone up. So increasing the total capital raised and the total equity, but for no dilution of the shareholdings. So that's another reason why share buybacks are popular. One of the reasons that gets a lot of press is particularly for short-term fixes to key financial ratios for investors. And this has got a lot of flack because a lot of managing directors and finance directors do share buybacks for this reason that I'm about to tell you about. So you can make a business look more attractive by going down the share buyback route as opposed to paying dividends, because key metrics like earnings per share are boosted. Earnings per share used a lot in the city to look at how robust and financially strong a business is. It's just the profitability divided by the number of shares in issue, basically. But if you're buying back shares, you're going to have fewer shares in issue, so that metric will increase the earnings per share. Also, often the PE ratio, the price to earnings ratio, the valuation of a business will increase because more and more people are coming in to buy the stock on the anticipation of a share buyback. That increases the share price. That increases the PE ratio. It also increases what is known as the return on equity, so the ROE. So increased earnings per shares, increased PE ratio, increased return on equity ratio, all these metrics are often factored into managing directors' performance bonuses. So typically CEOs of these big listed companies will benefit from short-term boosts in these metrics. So they would choose to do share buybacks as opposed to regular or continued dividend payouts, because doing the share buybacks will increase these metrics of the business. Now, the criticism is that these are only short-term fixes, not longer term. So these CEOs of these big firms are only in situ normally for an average of 3 to 5 years, and not really thinking about maximizing long-term shareholder value, which they should be doing. It's all about securing a short-term boost to the financial data, which in turn is pegged to their pay performance and their pay package. So this financial metric manipulation is obviously good for the bosses of these companies, because they're going to earn more, and often in many cases it's tens and tens of millions of pounds or dollars, even hundreds of millions, because often they are given these share rewards in shares, these performance rewards in shares. So the EPS, the ROE, the price earnings ratio all go up, and they get all these stock awards which vest, and then they get them for so many years, but they are worth often hundreds of millions of pounds. So that's another reason for doing share buybacks. So it's a quick fix to the financial ratios. Downside of buybacks, well, actually that was one of them as well. The downside of this short-termism for these chief execs to get their increased bonus, but also as well, it can affect companies' credit ratings, particularly if the companies are gearing up to do share buybacks. So right at the start of the video, I said often one of the reasons would be to return surplus cash. But let's say they haven't got surplus cash. They still may choose to do a buyback anyway, particularly to improve those short-term metrics. But how do they fund it? They fund it through borrowing. So increased gearing on the balance sheet, credit rating will take a tumble for that. Now, why would they do that? Because debt financing is cheap compared to equity financing. Go into the markets, raise several hundred million of debt. It's not that expensive for a company compared to raising the same amount in equity terms. Why? Well, two reasons. At the moment, we've got low interest rates, but even looking longer term, debt is tax deductible. The interest on the debt is tax deductible for a company. Dividend payments are not tax deductible. So that's a good reason commercially for wanting to gear up to fund these share buybacks, the fact that the cost of the debt is so cheap. So credit rating agencies are no fool. They cotton onto this and they see what's going on, and they will downgrade the rating of the company. So that is a downside for doing downside for doing these. And of course, being loaded up with debt is, even though low interest rates are there and everything else, you still see problems with firms leveraging up too much, notwithstanding the fact that the cost of the debt is low and they just cannot sustain the debt repayments. So and ultimately they could go under due to too much debt. So not necessarily a good justification to do share buybacks if you're going to take on a massive amount of debt. So that is just an overview of why companies choose to do share buybacks. They have been more popular in the USA than the UK, but the UK is doing more and more now. A lot of household name FTSE 100 companies are doing share buybacks as opposed to dividends, particularly in the last year or so with the COVID pandemic. But that, what I've just told you, is the reason why they are doing so. So I hope you've liked this video on investing, in particular share buybacks, something that you need to look at if you're an investor considering buying stocks in any of these companies, and look at the rationale for the share buybacks. But hopefully that's giving you a little insight into why companies do this. So if you like this video, please do subscribe here, and I will see you soon.